Welcome back to Simply Economics. For today's video, I've got something different for you guys, because I want to be talking about financial bubbles and why they keep occurring again and again. I'm going to dig into scientific papers on this topic without making it too long and too boring, and explain how we can use this information to say something about our situation right now. Are we in a massive bubble at the moment? I will end the video with how all of this relates to Bitcoin, so stick around to find out. Are you ready? Let's go. So, what is the definition of a financial or economic bubble? There are multiple definitions, but it basically always comes down to two phases. You have the run-up phase and the crisis phase. The run-up phase is a longer period when prices exceed their fundamental value, and this is the period where imbalances and financial bubbles occur. They often begin slowly, but then grow and keep bubbling until they've reached their peak. And the famous Wall Street saying goes, "Don't confuse brains with a bull market." Then in the crisis phase there's a sharp decline in prices and sometimes even market crashes. This is the point where reality hits and you find out that you and everyone else were not big brain geniuses after all. Of course we have experienced multiple bubbles in the past, right? Otherwise I wouldn't be making this video. We can go way back to the South Sea bubble in the 18th century, where even the smart Isaac Newton got caught in the madness and lost a lot of money during that period. And how about the tulipmania in the Dutch Golden Age, where at the peak some tulip bulbs actually sold for more than 10 times the average income of a skilled artisan. But we can also look at more recent bubbles, right? We had the dot-com bubble around the year 2000, when these internet companies, right, these dot-com stocks went sky high in price. Or we can look at the financial crisis, right, the housing crisis of 07-08, when the housing market collapsed and the risky derivatives like mortgage-backed securities and CDOs that were based on those mortgages, well, they took down whole financial institutions with it. So the big question now remains, why do these bubbles keep happening? Don't people learn from their mistakes? Well, our answer on this question could be found in experiments in behavioral finance. Remember, experiments in economics most of the time capture causal effects way better than your average basic model. Now, the paper by Nobel Prize winner Vernon Smith and some other people from 1988 showed that 14 out of 22 experiments exhibit price bubbles, followed by crashes relative to intrinsic dividend value. When traders were experienced, this reduced, but not eliminated, the probability of a bubble. Now, these results were not a coincidence, because the setup of this experiment has later on been tested for thousands and thousands of times in a different manner, so a little bit tweaked. And it showed that, for example, instead of using undergraduate students, they then used corporate executives or financial advisors, and it showed that these bubbles still occur. Now, what Smith and some other authors in 2001 showed was that in their paper they showed that when there was a lot of cash or a lot of liquidity compared to assets, the bubbles actually grew. And I think this is what we see in the real world today as well. There's so much liquidity, there's so much cash in the system at the moment that it has to flow somewhere. And I think this is why asset classes like stocks, like housing, like crypto, I think this is why these asset classes have seen such rapid price increases. Now, when these experiments were repeated 2 or 3 times with the same people, it looked like those bubbles disappeared. But the big question now is, are those results robust to changes in the environment? And this leads me to the last paper I want to briefly discuss, which is, again, the paper of Vernon Smith and some other authors in 2008. So first they show that when you replicate the same session multiple times, the bubbles disappear. But here comes the important part. They run 3 sessions, where the first 2 are identical, but in the third one they change the parameters, like different participants, more uncertainty, more cash. So they change the parameters and therefore the environment. And this means that the participants need to adjust. So what happened? Well, the bubbles actually reappeared, even though the participants had the experience of the first 2 sessions. And what's now the conclusion of all of this? Well, when the market environment changes for experienced subjects, we actually see that bubbles can reignite, which is exactly what we have seen in reality as well. We had the dot-com bubble where everyone was like, oh my god, internet stocks, tech stocks, this is the future. We had the housing market bubble where everyone was like, oh my god, this is the best investment ever. Housing is so safe, it's so stable, and nobody's going to default. And at the moment, of course, there are some other asset classes, but crypto is getting a lot of media attention, it's getting a lot of hype. Everyone's like, oh my god, this is the future. And of course, it has gone up a lot in price. So even though we knew about the dot-com bubble, we still invested in housing and created a housing bubble. And as we all know, it popped. And at the moment, we know of the dot-com bubble, we know of the housing bubble, yet we kind of tend to forget about it and still invest in these risky assets, like meme stocks, like cryptos, like NFTs. And this is what I'm trying to say. Every time the environment and the underlying changes, these bubbles re-emerge. And I think you can already sense what my take is on Bitcoin and other cryptocurrencies. I'm not saying it is a bubble yet, because it has not burst yet, but crypto tends to have a lot of bubble characteristics. It's something new, it's innovative, a lot of ordinary people are invested into it. It's quite difficult to understand, it's quite complex, it's very volatile, the price has gone up a lot, and therefore it's kind of like this perfect bubble asset. And therefore I think people should be really careful when they invest in these sort of assets. Make sure you really understand what you're investing in and diversify a bit, so don't put all your eggs into one basket. But that's it for today. I hope you learned something today. Feel free to like, comment or subscribe, and have a nice rest of your day.